Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick, and then encouraging snippets from cross-border capital on global liquidity. The global liquidity impulse is once again improving. Treasury bonds, the yields are high, but volatility, importantly, is reducing. And then, interesting insight from bond market analysis and the timing of Fed rate hiking cycle from Alpine Macro. It's quite positive. And I think whatever is positive for the bond market, we can read across for positive signals relating to the equity market. And then finally, quite a bit on China. There's actually some positive analysis on China at the end of the segment. Moving on now to global liquidity, it is encouraging. You'll remember for the last 2 or 3 weeks, cross-border capital have observed that global liquidity in fact has shrunk because of rising Treasury bond yields and the effect that that has on the value of collateral for new loans and the rollover of debt. However, the good news is that even if yields remain high, falling bond volatility could provide a welcome boost to global liquidity by reducing the size of collateral haircuts and raising the collateral multiplier. There's been a clear drop in bond market volatility as measured by the MOVE index. So the MOVE index is the Merrill Lynch bond option volatility estimate. Liquidity stress measures unexpectedly tumbled alongside lower bond volatility. And there's been another thing, the reverse repo operations from the Federal Reserve Bank. The reverse repo has diminished. Reverse repos is when the Federal Reserve sells bonds to the market, which it then repurchases at a higher price after a short period of time. So that drains liquidity from the market. And there's been a significant reduction in the reverse repo operations. So if bond market volatility follows the reverse repo program lower, according to cross-border capital, this could add $5 trillion to global liquidity. We continue to believe that the global liquidity cycle bottomed last October. This tailwind should bolster global equity markets right through into 2026. Insight from Alpine Macro regarding bond market analysis, the timing of the Federal Reserve hiking cycle, but we can definitely read across to equity markets from this. So they say that there are 4 Federal Reserve rate cycles. First one, hiking rates. The second one, holding at the peak. So on hold at the peak in rates, and that can last for a period of time. Cutting rates, the third one, and on hold at the bottom of the cycle. Which is best for bonds? Well, quite a bit of empirical evidence shows, according to Alpine Macro, that the best for bonds is when the Federal Reserve is on hold at the top of the cycle. The best excess returns occurred when the Fed was on hold at a high level. The perceived end of rate hikes reinforces hopes among investors that the Fed had successfully engineered a soft economic landing. The US currently has entered a macro and policy backdrop that historically proved to be constructive for the riskier parts of the fixed income market. Inflation is easing, and the economy is gradually softening rather than crashing. This combination could allow the Fed to pause while keeping alive hopes for a soft economic landing. We can read across the benefit to equities specifically for growth stocks that benefit from stable to lower bond yields, such as the technology sector. So now we do move on to China, first from MRB. They have been flying the flag in support of China. They continue to do so. This is what they have to say. Economic momentum perked up somewhat in August, and consumer confidence is improving. The underlying trend rate of economic growth is 5%. They agree long term the trend growth will decline to around 3% in 10 years' time. But the framework announced by the Politburo in July and implemented since then has a decent chance of successfully managing this gradual decline while avoiding financial instability or a balance sheet recession. This is inherently bullish for risk assets in China. It implies a more organic, sustainable expansion in Chinese domestic demand. Chinese equities are priced for a much weaker outcome than that. Hence, there is upside if there's any positive surprise in economic data. The clearest indication yet that Beijing wants to see share prices higher, a technical loosening in regulatory frameworks surrounding the equity markets, including lower transaction fees, easier ETF listings, and slightly expanded leverage on margin transactions for stock trading. And then the economic and trade momentum seems to be bottoming out. The official manufacturing PMI was under 50, i.e. in contractionary territory in August, but the biggest drag comes from shrinking export orders, nothing to do with domestic demand. Other components of the PMI measure were upbeat. Output jumped from 50.2 to 51.9, new orders from 49.5 to 50.2. The Caixin survey, which tends to represent more private sector activity, broke out into expansionary territory to 51, one of the best readings over the past year. Encouragingly, there was a sharp pickup in the seasonally adjusted employment subindex. Upward surprises to economic activity data are occurring. First of all, the MRB economic activity indicator is edging higher, running close, consistent with a trend rate in GDP growth of 5%. The Li Keqiang index, a proxy for heavy industrial activity, also ticked higher. And then finally, a pickup in the Citigroup Economic Surprise Index. The widely propagated foreign media narratives of a collapsing and underperforming Chinese economy are not supported by evidence. Overall measures of current momentum are running at a pace consistent with the government's 2023 growth target. The weakness of China's trade sector is primarily due to the normalization in demand for merchandise goods in the US and Eurozone, which is a cyclical phenomenon. The year's growth engine has been consumption, which continues to provide a steady tailwind. August saw a modest recovery in consumer confidence and a continued deceleration in the rate of growth of household bank deposits, which means less saving. Gielie, how are things looking on the local side?
Hi, Nick. Thank you once again for a very comprehensive macro overview. Locally, I think the most important news that broke on Monday afternoon, just before the market closed, is that Transaction Capital brought out a financial update just before close of market. The news is that SA Taxi is still struggling with a turnaround. They can't get that strategy right. We buy cars. There was an unexpected weakness. The expected turnaround did not materialize. And then the department, Newton, had a really indifferent performance. It does not look good at this stage. The share dropped 16% yesterday. That was before close of market. After close of market, Transaction Capital announced that the CEO, David Herwich, has resigned. He will leave at the end of December. From the look of things, he was basically forced out by the other directors, especially by the founders. One of the founders, Jonathan Jono, will take over the duties of David Herwich. They also called in the help of Chris Seabrook, one of the big shareholders, to help with the turnaround of SA Taxi. Statistics, the foreign net selling of local equities, it is now 108 billion this week. It's up a lot, so I think that's one of the reasons why the market is not really very strong. The foreigners are really dumping shares. Other statistics, the South African business confidence of Q3, so this is till the end of this month, end of September, that's already out. And the index regained some lost ground. It reached 33 in the third quarter, and that is up from a 3-year low of 27 that was recorded in the previous quarter, in Q2. This index varies from a scale of 0 to 100, so it just shows you 27 was the lowest ever. We're now standing at 33. It's still some way away, some way away from the middle of 50, which is neutral. For more than a year, this index kept dropping, but now there's a turnaround, but there's still some way to go there. The index remains firmly in pessimistic territory, and there's two reasons for that. One is the high interest rates, and the other is the social unrest. The next index is the consumer index, which is related to the business index. The consumer index, that varies from -100 to +100 with 0 in the middle, which is neutral. Increased to -16 points, and that is up from the previous quarter, which was at 25 points. That was also an all-time low, so that is turning around, which is good. They expect the confidence to rise even further, and this turnaround is really a result of confidence of high-income households after it has plunged to all-time low in the previous quarter. This is the main reason for this, for the turnaround, and there are also hope that the interest rates hiking cycle will end now. The exchange reserves, foreign exchange reserves are very high. It's at an all-time high. It was $62 billion in July, and in August it dipped with less than $1 billion, about $500 million it dipped. The reserves are made up of gold and foreign exchange, foreign currencies, held by the Reserve Bank. The last one is the South African current account for Q2. It's Q2 ending in June. This is a bit of a disaster. The current account is very simple. It's exports minus imports. And the current account deficit dropped to 160 billion rand. And that was the previous quarter, Q2, it was 63 billion. So it's a drop of 100 billion rand. The reasons for the drop is, of course, just that there was a rise in imports and the exports declined. As a ratio of GDP, the balance deficit jumped to 2.3%. That is up from 1% in the previous quarter.